study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole lot. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season.
All right, welcome back to our Study With Me session today. Today is what day? It's Tuesday. Today is Tuesday. Time goes by so fast. All right, so today again we will spend a few hours together. It may be 3 hours. So the first session is going to be 1 hour and 10 minutes. And then we will take a 10 minutes break. And then we'll continue. All right. So thank you very much. I'll talk to you in a minute.
Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole lot. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season. This is your season.
All right. So we are ready to get to work. Okay, everybody. So grab your books, your notebook, your pen, your pencil, and whatever you use to study. We're going to flip some pages. Okay, so let's go ahead and make it happen. I'll talk to you in a few minutes, about an hour and 10 minutes. All right. I need to stop the studying just for a minute so I can celebrate. I want to celebrate this moment because I just received this yesterday. I received this yesterday, and what's inside? What's inside is our bachelor's degree in finance. Okay, so I think you can't see it, but that's fine. It's just a symbol, but I received the envelope yesterday, and I want to show you that it's possible. Okay, if you put the time, you study, you work, you can do it. All right, so that's for someone that's nothing, but somebody that's everything they need to pursue their goals and their dreams. So I just wanted to stop and share this with you. All right, we'll celebrate. Okay, we're back on study mode. Okay, Bentley, have a great day. Deferred gain, unaffected cash flow hedge, 8,000 foreign currency, translation gain, 2,000 prior service, cost not recognized in the period, pension cost, 5,000. That is the inflation goal. Foreign currency translation, adjustment, cash flow hedge, gain, loss. Pension adjustment, unrealized gains, losses on certain investment, things that do not go in net income. -5 prior service cost, not recognized in net periodic pension cost. Help me understand, why did we do -$5,000, and why did we include foreign currency translation gain? If we already have the gain, it's not unrealized. Prior service cost not recognized in net periodic pension cost. That means the company has a pension lost cost that has not hit net income yet. Instead, accounting parks it temporarily in other comprehensive income. Think of other comprehensive income like a waiting room for certain gains and losses. So pension prior service cost bad for equity, cost loss reduce reduce other comprehensive income, therefore it is negative, so we treat it like -5,000. That's why we subtract it. Think of it, gain increase, lost cost decrease, so pension cost decrease, accumulated other comprehensive income. Why is foreign currency translation gain included if it's already gain? Right? The key word is not gain. The key question is, where does accounting send the gain? Some gains go to net income, some gains go to other comprehensive income. Foreign currency translation adjustments specifically go to other comprehensive income under GAAP. Why? Because the company usually has not actually converted, sold the foreign operation yet. A U.S. company owns a subsidiary in Europe. Last year, this year, 110. Now, when converting European financial statements into US dollars, the company appears to have a gain, but they did not actually sell anything or receive cash from exchange movement. So accounting says this is unrealized for now. Put it in other comprehensive income. Rockwell's financial statement. This one have December 31st. Foreign currency transaction. In this case, how do we know that the gain on the sale of equipment is already included in net income? Why not foreign currency translation gain? Why not unrealized gain on the available for sale debt securities? That is the whole game. Let's break this question slow. Start with net income. The problem already gives net income 400,000. That means all normal revenues, expenses, gains, losses that belong to the income statement are already included. It asks which item belong to other comprehensive income instead of net income. This is based on accounting rules. Gain on sale of equipment net income. Why? Because it is realized. Like you already included in net income, so we do not add it again. Foreign currency translation gain. Okay. Okay. If the question already gives you net income, then ask yourself which additional items belong to other comprehensive income. consolidated financial statement. Let me do consolidated. Dominate consolidated financial statement. Selected information from the separate and consolidated balance sheet and income statement of Bear Inc. and its subsidiary Shell Co. as of December 31st, year 1. And for the year then ended as follows. At December 31st, year 1, what was the amount of sales payable to Bear for intercompany sales? Account receivables 52, Shell 38. So what is the question? The question says, what was the amount of sales payable to Bear? Payable to Bear for intercompany sales. 52 minus 38. That's 14. That's 14. Accounts receivable, payable to Bear, inventory, revenue, cost of goods sold. Let me see. 52 plus 38. That's 90. 90 minus 78. 12. On December 31st, year 1, Saks Corporation was acquired by the corporation by Paul Corporation in the business combination. Paul issued 200,000 shares of its $10 par common stock with a market price of $18 a share for all of Saks's common stock. The stockholders' equity section of each company's balance sheet immediately before the combination is provided below. Immediately before the combination, common stock 3 million, additional paid-in capital 1.3 million, retained earnings 2.5 million. So what's the question? In December 31st, year 1 consolidated balance sheet, additional paid-in capital should be reported at what? Additional paid-in capital. $1.3 million, 150,000. Additional paid-in capital. It was 200. 200,000 shares of its $10 par common stock. 200,000 times 10, that's 2 million. Alright, just a moment. 200,000 times 18, that's 3,600,000. minus 2 million. That's 1,600,000. Additional paid in capital. $1,600,000. Question. In December 31st, year one consolidated balance sheet, additional paid in capital should be reported at what? 1,600,000, 2,900,000. Let me see. I would say 2,900,000. That's good. Which of the following should be disclosed in a summary of significant accounting policies? Summary of significant accounting policies. Accounting policies. Which of the following should be disclosed? Basis of consolidation, concentration of credit risk, financial instrument, composition of plan balance, adequacy of pension plan asset in relation to vested benefit. Basis of consolidation. Significant accounting policies. Accounting policy. Concentration of credit risk, of financial instrument, composition of plan asset, adequacy of pension plan asset in relation to vested benefits. How do you report? That has adequacy of basis of consolidation. Identify accounting principles used where GAAP allows in alternative used in the method of applying those principles. Revenue recognition policies, inventory costing system, LIFO, basis of consolidation, depreciation method, long-term contract accounting, criteria for classification of investment, basis of consolidation Which of the following should be disclosed in the summary of significant accounting policies? Summary of significant accounting policies. Basis of consolidation. Remember I took that note. Summary of significant accounting policies. Basis of consolidation. Basis of consolidation. Basis of consolidation. Basis of consolidation. Which of the following should be disclosed in summary of significant accounting policies? Significant accounting policies. Summary of significant Summary of significant accounting policies. Accounting policies. Okay. Identify accounting principles. Purpose. One note that is always included in GAAP financial statements is the summary of significant accounting policies. This summary discloses or discusses the accounting principles selected and method of applying those principles. When more than one acceptable reporting principle exists under GAAP. For example, the principle of consolidation describes which subsidiary companies are included within the consolidated financial statement in a manner in which intercompany accounting accounts and transactions are eliminated. Any subsidiaries not included or transactions not eliminated must be explained in this footnote, because there are multiple consolidation principles and approaches to produce consolidated financial statements. The basis of consolidation must be disclosed in the summary of significant accounting policies. Okay. So the purpose. Purpose of the significant accounting policies: identify accounting principles, accounting principles where GAAP allows alternatives. Alternatives and the method. And the methods of applying those principles. Applying those principles. Examples. revenue recognition policies. Revenue recognition policies. Revenue recognition policies, inventory costing system, FIFO LIFO, inventory costing system. Inventory costing system, FIFO LIFO, depreciation method, depreciation method, straight line sum of the year digits, long-term contract accounting, long-term contract accounting, over time of at a point in time, criteria for classification, over time at a point in time, at a point in time, criteria for classification of investments, criteria for classification of investment, investments, cash equivalents, trade and securities, trade and securities, basis of consolidation. That you gotta remember this. Basis of consolidation. Basis of consolidation. consolidation. So here we have the summary of significant accounting policies. Summary of significant accounting policies. Okay. The summary of significant accounting policies. Basis of consolidation is part of it. Consolidated financial statements are typically prepared when one company has a controlling financial interest in other unless consolidated financial statements are typically prepared when a company has a controlling financial interest in another, unless the subsidiary is a financial company, is a finance company. The fiscal year ends of the two companies are more than 3 months apart. The subsidiary is in bankruptcy. If the subsidiary is in bankruptcy, you will not consolidate. That's one of the cases you will not consolidate if there is bankruptcy. Prior to for consolidation of majority-owned subsidiaries, companies could possibly have excluded a finance non-homogeneous company, but not since that time. Thus, this is incorrect. Currently, the only reason allowable for not consolidating a majority-owned subsidiary is where control does not reside with the majority owner. Which one of the following is not a characteristic of consolidated financial statements prepared following an operating period that occurred after the date of business combination? Which one of the following is not a characteristic of consolidated financial statements? Not a characteristic. Which one is not a characteristic of consolidated financial statements prepared following an operating period that occurred after the date of business combination? A full set of consolidated financial statement will be required. The method used by the parent to carry on its books its investment in the subsidiary will affect consolidation process. Intercompany transaction may have occurred since the business combination. The method used by the parent to carry on its books its investment in the subsidiary will affect the final process will affect the final consolidated financial statement. Help me understand the difference between these two. Help me understand the difference between these two sentences. The method used by the parent to carry on its books, its investment in the subsidiary will affect the consolidating process. The method used by the parent to carry on its books, its investment in the subsidiary will affect the final consolidated financial statement. Very tricky, huh? The key concept in consolidation, the parent company can use different method on its own books to account for the subsidiary. Equity method, initial value method, partial equity method. Those methods change. The parent's journal entries, the parent's investment account balance, the parent's investment income account. So yes, the consolidation process changes. But after all consolidation adjustments, eliminations are made correctly, the final consolidated financial statements should be the same. The method used by the parent to carry on its book, its investment will affect the final consolidated financial. The method will affect the consolidating process. That statement is actually true. Different method require different consolidation entries. Process changes. So what's the question? The question is, which of the following is not a characteristic of consolidated financial statements prepared following an operating period that occurred after the date of a business combination? Help me analyze this question word by word to understand what exactly it's asking. Which of the following is not a characteristic of consolidated financial statements prepared following an operating period that occurred after the date of business combination? Let's dissect it slowly. Which of the following is not? This means you are looking for the false statement. Yeah. Okay. This alone tricks many people. Okay. Part 2, a characteristic, meaning something that is true about. So the question becomes, which statement is not true about consolidated financial statement? Yeah. Which of the following is not a characteristic? The method used by the parent to carry on its books, its investment in the subsidiary will affect the final consolidated financial. It will not affect the final consolidated. I understand. Okay. Consolidated financial. financial statement. Which statement is not true about consolidated financial statements? Consolidated financial statements, meaning parent plus subsidiary combined together as if they are one company. Important. Intercompany accounts eliminated. Investment account eliminated. Subsidiary equity eliminated. You are now in consolidation world. Prepared following an operating period. This is very important. This means not the acquisition date itself, but after operations have already happened, meaning time has passed. Time has passed. The companies operated together. Revenues, expenses occurred. Intercompany transactions may exist. This tells you we are talking about post-acquisition consolidation. Post-acquisition consolidation. Yeah. So, put the entire sentence together. The question: after a parent has already acquired a subsidiary and some operating time has passed, which statement about the final consolidated financial statement is false? That is the true meaning. Why this matters for the answer: once you understand we're after acquisition, we're preparing consolidated statements, final consolidated statements are being discussed, then you remember the major rule. Different investment methods affect parents' own books, worksheet entries, consolidation process, but not the final consolidated statement. Excellent. Okay. So, different investment method affect parents, then you remember. Okay. Which of the following is not a characteristic of consolidated financial statements prepared following an operating period that occurred after the date of business combination? The method used by the parent to carry on its books, its investment in the subsidiary will affect the consolidated financial statement, will not affect it. So, it will not affect it. And this that you need to understand. You gotta understand this part. Okay. So, gotta take some notes on that. Once you understand why this matters, once you understand we're after acquisition, we are preparing consolidated statements. Final consolidated statement are being discussed, and you remember different investment methods affect parents' own books. The method used by the parent to carry on its books is in its investment in the subsidiary will affect the consolidating process. Different investment methods affect different investment method. Different investment methods affect entries consolidation process. Parents on books, worksheet entries, worksheet entries, consolidation process, but not the final consolidated statement. Not the final consolidated statements. Final consolidated statement. Statements. Okay. So the method used by the parent to carry on its books, its investments in the subsidiary will affect the consolidating process. The method used by the parent used by the parent to carry on its books, to carry on its books, its investment, its books, its investments, its investment in the subsidiary will affect the consolidating process. Consolidating process. But not the final consolidated financial statements. But not the final consolidated financial statements. Okay. All right. All right, it's time for our break. It's time to be on break right now. We'll be back in 10 minutes. All right, so time for break. Get some water, enjoy your break, and we'll be back here in 10 minutes. Okay.
Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole lot. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA. I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top, put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA. That's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life on the other side. Come study with me, come and study with me. Come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say. Come study with me, come study with me. Come and study with me, come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me. Come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life on the other side. Come study with me, come and study with me. Come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah. Late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA. That's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it. Yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride. Just a bigger life on the other side. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top. Put your name on top. This is your season. This is your season. This is my goal. What is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole loaf. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA. See the fire, I hear you say.
Come study with me. Yeah. Come on now. Come study with me. All right, we are back. We are back. This is your season. Yeah. Ladies and gentlemen, this is your season for you to grow. This is your season for you to come and study with me. All right. We are back, ladies and gentlemen. Thank you very much for sticking around with me. We are flipping some pages. We are putting value on ourselves. We're becoming better and better every time, every day. This is it. You know what I'm saying? This is what it is. Let's go ahead and make it happen. All right? So, let's get back to the book. I'll see you in an hour and 10 minutes again. Which of the following is not a characteristic of consolidated financial statements prepared following an operating period that occurred after the date of a business combination? Is not a characteristic of consolidated financial statement. A false at the unit that the method used by the parent to carry on its books, its investment in the subsidiary will affect the consolidating process. Yes. Intercompany transactions may have occurred. Yes, since the business combination, that's right. The method used. The method used by the parent to carry on its books, its investment in the subsidiary will affect the finance consolidating financial statement? No. On December 31st, 2008, Pico acquired 250,000 par value of the outstanding 1 million bonds of its subsidiary. sentence on December 31st, 2008. Okay. This gives you the date of the transaction. No calculation yet. Pico or Pico acquired meaning parent company bought something. This is an investment purchase. $250,000 par value. Very important keyword, par value. This tells you face amount of bonds purchased, not purchase price. Yes. So Pico bought 250,000 face value of bonds. Okay. Next part of the outstanding $1 million bonds. This tells you total bonds issued by cycle equals $1 million. Pico bought 250,000 out of 1 million, so that's 25%. So Pico purchased 25% of the bonds. Next part of its subsidiary cycle. Very important. This means parent bought subsidiaries bonds. This becomes intercompany debt. That is the major topic being tested. Intercompany debt. Next part, in the market for 200,000. This is the actual purchase price, 200,000, but the par value is 250,000. So face value purchased 250,000, market purchase price 200,000. This means the bonds were purchased below par. That suggests market rates changed. But notice carefully, the question is not asking for gain, loss on extinguishment, huge trap. Next part, on that day, Cycle had $100,000 premium on its total bond liability. This means Cycle's bonds are carried on books at 1 million plus 100,000. Because bond premium increases carrying value. Okay, bond premiums increase carrying value. Bond liability carrying value formula: face value plus unamortized premium. So 1 million plus 100,000 is 1,100,000. Now the actual question: which one of the following is the net carrying value of Cycle's total bond liability? Total bond liability, not just the portion purchased, not consolidated amount, not extinguishment amount, the entire liability. Net carrying value. Base plus or minus premium discount. Since premium exists, 1 million plus 100,000, 1,100,000. Okay. So if I understand this, Cycle had, okay, on December 31st, Cycle acquired for value of the 1 million bond of its subsidiary since Cycle in the market for 200,000. That day, Cycle had a $100,000 premium on its total bond liability. Which of the following is the net carrying value of Cycle's total bond liability? Okay. Value of the outstanding bonds. Okay. So here's 1 million. On that day, Cycle had $100,000 premium on its total bond liability. What is a Well, I understand the premium, but what is the premium? Explain the premium to me again. So, on that date, Cycle had $100 premium. Where is the premium coming from? This is a root understanding you need for bonds. Let's slow it down. What is a bond premium? A bond premium premium happens when investors are willing to pay more than the face value of the bond. When they are willing to pay more than the face value of the bond. When they are willing to pay more than the face value of the bond. So if face value is 1 million, face value is 1 million, investors paid 1,100,000. Then 1,100,000 minus 1 million is 100,000. That extra 100,000 is the premium. Extra 100,000, that's the premium. But why would investors pay extra? Because the bond's interest rate is attractive. They pay extra because the bond interest rate is attractive. Simple real life example. Okay, got it. Is the net carrying value of Cycle's total bond liability. Okay, so what is the concept that is being tested here? Because they gave me the outstanding, the 1 million bonds, and they also give me the premium, and they're asking what is the net carrying value. What is being tested here? How else could they ask this question, or what variation would cause the answer to change? Bond carrying value, specifically, can you distinguish between face, par, and carrying book value? That is the real concept. The core formula being tested for bonds: if premium exists, carrying value equals face value plus if discount exists, carrying value face value minus. That's the main idea. If discount exists, carrying value face value. What the examiners are trying to see. Okay. This is On January 1st, year 1, Pearl purchased all of Scott's common stock for $360,000. On January 1st, year 1, the fair value of Scott's assets and liabilities equal their carrying amounts of $410,000 and $160,000 respectively. The fair value of Scott first policy is to amortize intangible assets over 10 year period unless a definite life is ascertainable. During year one, Pearl and Scott paid cash dividends of 100,000 and 330,000 respectively. There were no intercompany transactions except for Pearl's receipt of dividends from Scott and Pearl's recording of its share of Scott's earning. What's the question? In December 31st, year one, consolidated balance sheet total retained earnings should be. So here we're talking about total retained earnings 755. Pearl Scott paid cash dividend. There were no intercompany transaction. Common stock, the fair value, their carrying amount of the fair value of Scott inventory was more than its carrying amount on the acquisition date. Pearl policy is to amortize intangible assets over a 10-year period unless a definite life is ascertainable. Pearl purchase everything 755. Retained earnings. Equity. So report. December 31st, D1 selected information. When one entity obtains a controlling financial interest in another entity, consolidated financial reporting is required. The combined company is viewed as a single economic entity because all of its resources are controlled by the acquirer. Using the equity methods, Scott's earnings and dividends during the year are reflected in the pair's investment account balance sheet and equity earnings in subsidiary account income statement. Scott's dividends are recorded as reduction in the investment account and do not impact Pearl's retained earnings. There are no controlling interests because Scott is wholly owned subsidiary of Pearl. All of the Scott's equity account are eliminated through consolidation on December 31st, year one consolidated balance sheet. Pearl's retained earnings 755. Okay. Parker Corp owns 80% of Smiths Inc. common stock. During year one, Parker sold Smiths 250,000 of inventory on the same terms as sales made to third parties. Smiths sold all of the inventory purchased from Parker in year one. The following information pertains to Smiths and Parker cost of goods sold for year one. What is Parker's consolidated cost of goods sold for year one? Parker cost of goods sold 400,000. So Parker Corp owns 80% of Smith Inc.'s common stock. During year one, Parker sold Smith $250,000 of inventory. Okay, on the same term as sales made to third parties. is consolidated cost of goods sold. Cost of goods sold. Sold the following information pertains. Cost of goods sold for year one. Smith 350,000. But remember that Parker sold Smith 250,000 of inventory. So that 250,000 sold to itself should be eliminated. So that's why we only have $100,000 left for Smith. So that's gonna be 500,000. On December 31st, year one, Saks Corporation was acquired by Poe Corporation. In a business combination, Poe issued 200,000 shares of its $10 par common stock. $10 par common stock with a market price of $18 a share for all of the Saks common stock. The stockholders' equity section of each company balance sheet immediately before the combination was. Okay, in December 31st, year one, consolidated balance sheet common stock should be reported at consolidated balance sheet common stock. Common stock is right here. 3 million. Stock is eliminated, is dissolved for subsidiary, so 3 million. But one more thing is, in the business combination, Poe issued 200,000 shares of its $10 par value of par common stock with a market price of $18 a share. So here you have another 2 million. That's why it makes it 5 million. Alright, Sun Inc. is a wholly-owned subsidiary of Patent Inc. on June 1st, year one. shares treasury stock. So you bought it from yourself, you make there is no profit. Which of the following kind of accounts is least likely to be eliminated through an eliminating entry on the consolidated worksheet? Receivables, investment, goodwill, payables. Receivables can be eliminated, investment can be eliminated, payables, goodwill. Why not? Okay. So I want an explanation, not just knowing that, but I want to know why. Alright, so if the answer is goodwill, why goodwill? Why goodwill is the least likely to be eliminated through an eliminating entry on the consolidation worksheet? Which accounts are usually removed in consolidation? The keyword is eliminated through an eliminating entry. Eliminated through an eliminating entry. Meaning which accounts usually get canceled out because they are between related companies. They are between related companies, okay? What gets eliminated in consolidation? In consolidation, the parent and subsidiary are treated as one company, so anything the company owe each other gets removed, because from the group perspective, you cannot owe yourself money, you cannot sell to yourself, you cannot invest in yourself. So no receivables, no investment, no payables. Ha! That's good. This is good. So anything the company owe each other gets removed, because from the group perspective, you cannot owe yourself, you cannot sell yourself, you cannot invest in yourself. Let me take some notes. You cannot owe yourself money. You cannot sell yourself. You cannot invest in yourself. So that removes receivables, account payable, receivable. That removes investments. You cannot owe yourself payable. You cannot sell to yourself receivables. Investments. So that's why goodwill is the right answer in this case. Because which of the following kinds of accounts is least likely to be eliminated through an eliminating entry on the consolidated worksheet? Goodwill, because receivables you cannot sell to yourself, investment you cannot invest in yourself, payables you cannot owe yourself money. Clark Co. conducted the following transactions with affiliated parties during year one. Sales of $60,000 of Dean Inc. with $20,000 gross profit. Then had $15,000 of this inventory on hand at year end. Clark owns a 15% interest in Dean and does not exert significant influence. Now it's not 20%. Purchases of raw materials stolen. Before eliminating entries, Clark had consolidated current assets of $320,000. What amount should Clark report on its December 31st year one consolidated balance sheet for current assets? $60,000 Dean. Parties during year one sales of $60,000 Dean Inc. with $20,000 gross asset. Do you have any current asset here? Then $20,000 gross profit. Dean had $15,000 of this inventory on hand at year end. You don't care. Club owns 50% shares in Dean. So here, with Dean, you have $20,000 of current asset. Purchases of raw material totaling $240,000 from Kent Corp, a wholly owned subsidiary. Kent's gross profit on the sale was $48,000. Clark had $60,000 of this inventory remaining in December 31st, year one. So if you bought $240,000 from Kent, subsidiary, you bought it from yourself, so that means it's a big profit. Inventory means that profit to sell was $48,000. Clark had $60,000 of this inventory remaining. December 31st, year one. It doesn't mean too much, right? That's the only problem here. That's the only problem is the $48,000. 320 minus 48,000. That's what I believe is the only problem in this case. Minus 48,000. 272. 272 is not an option. That's what I believe is the problem. This question is testing one of the biggest consolidation concept: unrealized intercompany profit in ending inventory. And the question is trying to see, do you know when to eliminate profit and when not to? Let's dissect that carefully. Read the structure. There are two separate transactions. Yes, one matters, one does not. Well, the first one does not matter. Transaction 1 sells 60,000 Dean Inc. Then Clark owns 50%. Interest Dean does not exert significant influence. This is very important. That means Dean is not a subsidiary. Dean is not consolidated. Dean is basically an outside company. So even though they are affiliated, this is not a consolidated intercompany transactions. Therefore, no elimination. Make sense? Here's the CPA rule. Consolidation elimination happens mainly between parent and subsidiary, not normal outside investment. Okay? So transaction 1 is a distraction. Ignore it. Transaction 2, this is the real problem. Purchases from Kent Corp, a wholly owned subsidiary, right? Wholly owned, consolidation required. In inventory remaining, unrealized profit exists at year end. This is the actual tested concept. Okay, so you have Clark has 60,000 of this inventory remaining on December 31st, year 1. Okay, let me do something here. Just see. 240,000. The 140,000. Wait. 240. 48,000. Into 48,000 divided by 240,000. That's 20%. So $48,000 is 20% of 240,000. So here the fake profit is 20%. So 20% of this inventory, since you have sold, so the profit is not fake anymore, but now you still have $60,000 left. From that $60,000, there is a fake profit. So 20% of this. What is 20% of 60,000? 12,000. So $12,000 before eliminating Clark consolidated current asset. So you're gonna take, you're going to say 320,000 minus 12,000. That's 308,000. I see. See the reasoning behind this. September 1st, year one, Philips Inc. issued common stock in exchange for 20% of Sago. 20% of Sago Inc.'s outstanding common stock. September 1st, year one, Philips Inc. issued common stock in exchange for 20% of Sago Inc.'s outstanding common stock. On July 1st, year 2, Philips issued common stock for an additional 75%. So now you have 95% of Sago's outstanding common stock. Sago continues existing as Philips' subsidiary. How much of Sago's year 2 net income would be reported as accruing to Philips? 95%. But read everything. 20% of Sago's net income to June 30th, and 95% to net income from July 1st to December 31st. Gotta read, because they're gonna trick you. They're trying to trick you if you don't read. Okay. Trick you if you do not read. During year one, Part Corp sold goods to its 80% owned subsidiary, Seed Corp. At December 31st, year one half of these goods were included in Seed's ending inventory. Year one selling expenses were $1.1 million. $1.1 million for part and $400,000 for seed. Part selling expenses include $50,000 in freight out cost for goods sold to seed. Part did not charge seed for these costs. What amount of selling expense would be reported in Part's year one consolidated income statement? What amount of selling expense should be reported in Part's year one consolidated income statement? So, Part cost sold goods to its 80%, so you own the company. You cannot sell to yourself. That's the first thing you need to know. At December 31st, year one half of these goods were included in Seed's inventory. Ending inventory. Year one selling expense were $1.1 million for Part and $400,000 for Seed. $1.1 million for Part and $400,000 for Seed. Part selling expenses include $50,000 in freight out cost for goods sold to Seed, sold to yourself. Part did not charge Seed for these costs. What amount of selling expenses should be reported? Selling expense should be reported in Part's year one consolidated income statement. Did you sell anything? You didn't sell anything to anyone, but say half of it. So if half of it remained, that means you sold half. Okay? Unit selling expense were 1.1 million for part, 400,000 for seed. Part selling expense include $50,000 for it. Trying to understand this. Where do you handle that? One half of these goods were included in seeds. Ending inventory. U1 selling expense were 1.1 million. So for part and 400,000 for seed. Selling expense. Selling expense. Part selling expense includes 50,000 in fried out cost for goods sold to seed. Trying to understand where the problem is. U1 selling expense is 1.1 million. Okay. It's one company. You sold it to yourself and you sell it to outsiders. I would say easily say 1,450,000, but I need to understand where this is coming from. I need to understand where it's coming from. I need to see where it's coming from. Need to see where it's coming from, my friend. Okay. So help me analyze this question word by word to understand where the problem is and find the answer. What's being tested here? This question is testing a very specific consolidation idea which intercompany costs get eliminated in which they, let's go slowly. First sentence, part corp sold goods to its 80% owned subsidiary, Seed Corp. So it owns the company. Keyword: sold goods. Intercompany sale. 100% owned. Consolidation required. So immediately your brain should think, this is a parent subsidiary consolidation question. Yes. At December 31st, year 1 half of these goods were included in Seed's ending inventory. Alright, this is testing unrealized inventory profit, but here is the trick. The question later asks about selling expense. Alright, so at December 31st, year 1 half of these goods were included in Seed's ending inventory. This is the unrealized inventory profit. But here there's the question later asks selling expense, not inventory. So this sentence is mostly a distraction. Aha! It is a distraction. They want to say if you panic and start eliminating inventory profit. But the question is not asking about inventory, cost of goods sold, unrealized profit. It is asking only selling expenses. Huge difference. Next sentence. Year 1 selling expenses were 1.1 million for part and 400,000 for Seed. This gives total reported selling expenses before consolidation. So start with 1.1 million plus 400,000, 1.5 million. 1.1 million for plus 400. Yes, that's 1.5 million. Next sentence. This is the real issue. Parts selling expense included $50,000 in freight out. Cost for goods sold to Seed. Keyword: freight out, selling expense. Goods sold to Seed, intercompany. Now we ask, should this selling expense remain in consolidation? Next sentence. Part did not charge Seed for these costs. This is the key sentence, meaning parent paid shipping. Subsidiary was not billed. No intercompany receivable payable created. So this is a real expense to the consolidated entity. The group actually spent this money externally. Core consolidation rule: you eliminate intercompany revenue, intercompany expenses, intercompany profits. But you do not eliminate real expenses paid to outsiders. Freight was paid to UPS, trucking company, whoever. So consolidated group truly incurred the cost, therefore keep the expense. Final answer: no elimination needed. Consolidated selling expense. Okay, so answer 1.5 million. I don't think so. Sometimes chat, you don't give the right answer, chat. Sometimes your reasoning is off. Is there any circumstance in which the answer could be 1,450,000? Sometimes chat, you don't know. It's excellent thinking. Now you're asking what fact pattern would make the freight out eliminated. That is how you master. Alright, the answer could become if the 50,000 represented an intercompany charge instead of a real external expense. Current question: the problem part did not charge Seed for the cost. In part paid us and keep it. How could it become? really don't want to get the right answer, so I can come back to this question. Well, according to the exam or to the exercise, the answer is actually 1,450,000. Internal transfer. Find out related to intercompany sale. All right, everybody, it's time for us to take a break. Time for break. We will be back in 10 minutes. We'll be back in 10. We'll be back in 10 minutes. Go ahead, drink some water, take a break, relax, stretch your body, because we're gonna come back for another 1 hour session, 1 hour and 10 minute session. Let's go ahead and do it, man. I feel that I'm learning something. I don't know about you, right? But I feel that I'm learning something. So let's go ahead and take a break, and then we'll be back in 9 minutes. All right, enjoy your break.
Fresh highlighters, head down, focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me. Come and study with me. Put your name on top. Put your name on top. This is your season. This is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride. Just a bigger life on the other side. Come study with me. Come and study with me. Come study with me. Put your name on top. Put your name on top. This is your season. This is your season. This is my goal. What is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah. Late nights, clean notes. I want the whole lot. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life from the other side. Come study with me, come and study with me, come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. Yeah, yeah, yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me, come study with me. Come and study with me, come and study with me, come and study with me. Put your name on top, put your name on top. This is your season, this is your season. From the first page to the final light, I want your future to feel this bright. No wasted years, no empty pride, just a bigger life from the other side. Come study with me, come and study with me, come and study with me, come study with me. Put your name on top, put your name on top. This is your season, this is your season. This is my goal, what is yours? Come build that dream and open doors. Come study with me. Come study with me. Come study with me. Come and study with me. Yeah. Late nights, clean notes. I want the whole load. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes, you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA. I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top, put your name on top. This is your season. This is your season. Yeah. Library cards, fresh highlighters, head down, focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA. That's the climb, that's the way. This is my goal. What is yours? Open that door, unlock more. Yes, you can do it, yes, you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me.
Yes, come study with me again. Come study with me again. Let's go. This is our last session. This is the last session, and come study with me. We will spend about 1 hour again. We will spend 1 hour together, 1 hour and 10 minutes. Deep focus so that we can achieve our goals, achieve our dreams, because ain't nobody else gonna do it for you. You gotta do it for yourself. So this is the moment where you will focus. This is the moment for you to make it happen. So let's go ahead and go back. I'll talk to you in a few more minutes. Go back to work. Our selling expense include $50,000. Alright. Charge seed wording. matters. That wording prevents creation of intercompany receivable payable, but it does not prevent elimination of the selling expense tied to internal transfer. But okay, it's internal transfer. Well, we should not ignore the $50,000 altogether because it was an expense in a way. It may not be part of the consolidated income statement, but if you spend $50,000 to move products, it is an expense. Yeah, freight out is a selling expense. It is tied to cost delivering goods to customers, but in this case, who received the goods, not an outside customer. The goods were sent to subsidiary. From consolidated perspective, the inventory never left the company group, so the sale is ignored. And because the sale is ignored, the freight out tied to the internal sale is also ignored as a selling expense. Yeah. But one more thing I'm trying to understand is the $400,000 of seeds selling expense. It's the same company. The parent company has a 1.1 million selling expense. What I'm looking at, what are the possibilities for both companies to have different selling expense? Because before consolidation, they are still separate legal companies with separate books. Consolidation happens only at reporting time. Think of it this way. Imagine parent company part has its own employees, its own marketing department, its own shipping department, its own accounting records, and subsidiary also has its own employees, its own sales team, its own offices, its own accounting records. Even though the parent owns the subsidiary, they still operate separately day to day. So each company records its own expenses. Part record 1.1 million. Seed records 400,000. These are their separate company financial statements. Then consolidation combines them. At year end, accounting says, pretend these two companies are one giant company. So we add assets, add liabilities, add revenues, add expenses, then eliminate internal transactions. Okay. Then consolidations combine them. At year end, accounting says, so we add asset, add liabilities, add revenues, add expenses, then eliminate internal transactions. Eliminate internal transactions. Add consolidation. Okay. Year 1 selling expense part selling expense include fitting for here. Okay. Okay, makes sense. So you add asset, liabilities, revenues, and expenses. Eliminate internal transactions. Okay. In consolidation, we add assets, add liabilities, add asset, add liabilities, add revenue, add expenses. Add expenses. Then eliminate internal transactions. Eliminate internal transactions. Okay. Sold goods to aided expenses were 1.1 million for part and 400,000 for C. Part selling expense included 50,000 in freight out cost for goods sold to seed. Part did not charge seed for these costs, but amount of selling expense should be reported in Part's Year 1 consolidated income statement. That's internal transaction, you remove it. Part has 400,000, you keep expenses, these are expenses, you add them. Internal transaction, you remove. Alright, okay. ASECO has significant investments in 3 separate entities: Capco, Placo, Simco. Ownership of voting stock 40%, 60%, 100%. Which of these investments would be consolidated in ASECO's financial statements? 2 of them, Placo and Simco. Which of the following levels of voting ownership is normally assumed to convey significant influence over an investee? Significant influence from 20 to 50%. From 50 to 100%, that's controlling interest. What is the effect on the financial statement if a company fails to eliminate intercompany sales at a profit against intercompany purchases? Consolidated asset. If you fail to eliminate sales at a profit, against intercompany purchases, so you sell something to yourself, you make a profit on it, your net income will increase, will overstate it, because it will look that you made more money than what you actually made because you sold the thing to yourself. What happens to your asset? Consolidated assets. Assets remain the same. Your assets remain the same. Your net income increases. So your asset will be understated, because it will show that you have less asset than what you actually have, but it will show that you have more money than what you actually have. But you don't have that. Overstated. No. Asset will be understated and net income will be overstated. Asset will be overstated. Consolidate. Net income will be overstated. Help me understand asset, overstatement of asset in this case. They have the potential to distort overall financial statements. Sales of goods between subsidiary and parent are reported on the parent subsidiary company's individual financial statements. Sales of inventory increase gross profit. Things to remember. help me understand why asset will be overstated in this case. I understand net income will be overstated because it will show that you made profit that you didn't actually make because you sold it to yourself. Asset, I believe asset will remain the same. Or yes, explain that to me. Why assets are overstated? The key phrase in this question: intercompany sales at a profit. This means parent sells inventory to subsidiary for more than cost. Yeah. What happens on separate books? Seller records, sales revenue 100. I said overstated because it will show that you have more asset. Okay, almost there. Which of the following factors would not affect a parent's adjusting in entries to prepare a consolidated balance sheet immediately following the acquisition of a subsidiary? Which of the following factors would not affect the parents adjusting entries to prepare a consolidated balance sheet immediately following the acquisition of subsidiary? Whether intercompany payables existed, whether the business combination resulted in goodwill, whether the parent uses the cost method or equity method to account for its investment in the subsidiary, whether the parent wholly owns subsidiary or if there is a controlling interest. Merchandise exclusively to C and C sales children to external customers. What amount should be reported as gross profit in the consolidated income statement for year ended December 31st, year 1. December 31st, year 1. What amount should be reported as gross profit in the consolidated income statement for year ended December 31st, year one? December 31st, year one. What amount should be reported as gross profit? Cost of goods, cost of sales, beginning inventory, ending inventory, sales, cost of sales. So what do? You add asset liabilities, revenues. You add them. Add asset liabilities, revenues, expenses. Eliminate internal transactions. So this is sales. You can add them. Cost of sales, you can add them. So we say 130 plus 91. Plus 91, 130,000 there's 91,000, 221,000. That's sales. Cost of sales 165 minus 165,000. So that's $56,000 left. Should be considered as the gross profit. $56,000. No. 41. How could it be 41? Minus 65 ending inventory. It's not that easy. They're not gonna give it to you so easily. Okay. The question is, what amount should be reported as gross profit in the consolidated income statement for the year ended December 31st, year one? The answer is 41,000. Help me understand that. Consolidated gross profit with intercompany inventory. This is one of the most important. Understand the structure. Now to look at B. So B gross profit 130 minus 130,000. 130 minus 130,000. But this is internal profit because B sold to C. So this profit is not automatically real from consolidated perspective. Step 3, look at C. Sales 91,000, cost of sales 65. Gross profit 26,000. Okay, 91 minus 65, 26,000. These are external sales. So this part matters for consolidation. Step 4, the inventory clue. C ending inventory 65,000. This means C did not sell everything externally. Some intercompany inventory remains unsold. Therefore, some of B's internal profit is unrealized. Step 5, find B's markup rate. B sold inventory 130,000, cost 100,000, profit 30,000, markup on sales. Okay, 23%. Step 3, unrealized. Yeah, they ain't gonna put it so easy for you. They're not gonna put it so easy. So this is something you need to go back to learn it again. Review it. Okay. So alright, Wagner, a holder of $1 million Palmer Inc. bond, collected the interest too, and then sold the bond to Seal Inc. for $975,000 on that date. Palmer, the 100% owner of Seal, had a $1,075,000 carrying amount for this bond. What is the gain report recognized on this transaction for the consolidated group? Is there any gain? So Wagner, a holder of $1 million Palmer Inc. bond, okay, collected the interest due and then sold the bond to Seal Inc. for $975,000. On that date, Palmer, the 100% owner of Seal, had a $1,075,000 carrying amount for this bond. What is the gain recognized on this transaction for consolidated group? Is there any internal transactions here? So let's go ahead and let me do that because I'm gonna need some explanation. Need something to explain that to me. Okay. Intercompany bond transactions, specifically what happens when one company in the consolidated group buys another company's bonds. Let's go slowly. Step 1, identify the parties. Wagner, Seal, Palmer. Okay. Intercompany bond retirement. Before I do that, let me see what. Okay, tell me. 975. Seal pay 975. Answer 100,000. Gain. Alright, no problem. Let me do that real quick. This is something that I need to come back All right, who's studying with me today? Who is studying with me today? If you are studying with me anywhere on the planet, on the social media world, just go ahead and drop a comment somewhere so we can see that you're here. Let me know what you're studying right now so that we can encourage each other. Because it's not easy. It's a real fight, my friend. It's a real fight. This is a lock-in session, man. This is lock-in season. You know, we gotta fight. Gotta fight for what we want. Fight for your life. Fight for your goals. And fight for your dreams. Fight for your family. Let's get it. Alright. So, B-Taco owns 80% of all FACO. Both companies have a December 31st fiscal year, and there were no intercompany transactions between the firms during year one. Individually, Bitaco had $30,000 of net income for year one, while Alfaco had $10,000 of net income. What amount should be reported in the consolidated income statement as net income for year one? Net income for year one. Bitaco owns 80% of Alfaco. Both companies have a December 31st fiscal year, and there were no intercompany transaction between them. Okay, that's great to say. Individually, Bitaco had $30,000 of net income for year one, while Alfaco had $10,000 of net income. What amount should be reported in the consolidated income statement? And net income for year one, $30,000 or $40,000. Because if there is no intercompany transaction, there is nothing to eliminate. So you add revenues and move on. Let me see what you're saying. Yes, that's right. Consolidated income statement. Net income less income attributable to controlling interest, income attributable to parent. So the income statement. Okay. 22 of 24. We're almost there. On January 1st, year one, Polk Corp and Strass Corp had condensed balance sheet as follows. Alright, let's see. As follows. All of these. What's the question? Oof. On January 2nd, year one, Polk borrowed $60,000 and used the proceeds to purchase 90% of the outstanding common shares of Strass. That is payable in 10 equal annual principal payments plus interest beginning December 30th, year one. The excess cost of the investment over book value of acquired net assets should be. Ooh. Okay. Sorry. Yes. Let me see. Okay. You need to get the answer first. This chat sometimes is off. It's correct. Just do the correct one. How this happens. Consolidated balance sheet after acquisition, specifically when liabilities remain after consolidation. And the trick is do not eliminate real external debt. Let's go carefully. Step 1, before acquisition, initial investment. Okay. Which of the following must be eliminated as part of the consolidation process? Intercompany accounts receivable, intercompany sales revenue. Receivables should be eliminated. Revenue should be added. Intercompany sales revenue. I know what you're talking about here. Intercompany sales revenue. So is it something I sell to you that we sell to each other inside of the group, or I don't get it. Receivable should be eliminated, but I'm gonna say no. I'm gonna say revenues will not be eliminated, because receivable, that would be, yeah. Receivable, yes. Revenue, no. Let's see. Yes. Which of the following must be eliminated as part of the consolidation process? Intercompany sales must be consolidated. Eliminated. I don't know why you say that. Transaction between related and unrelated companies. I understand, but what do you mean? What do you really mean? I don't get it. Alright, let me do that. Let me understand. Okay. We're gonna get it. Now, we're gonna get it, my friend. It's gonna happen, my friend. It's going to happen. So it says intercompany sales revenue. Intercompany sales revenues, what I'm thinking about is revenue sales to outsiders. It's not, because if they were talking about revenues inside of the group, it would be receivable or payable. I know in the consolidation process, you add assets, you add liabilities, you add revenues, and you eliminate internal transactions. Is this considered an internal transaction, the intercompany sales revenue? In the consolidation process, you add asset, liabilities, revenues, and eliminate internal transactions. That's exactly correct. Now let's connect that to intercompany sales revenue. What does intercompany sales revenue mean? It means one company inside the group sold to another company inside the group. Example, parent sells inventory to subsidiary. 100,000 parent. Okay, so that's what it means. That's what it means. Intercompany. Whenever you see inter, is selling to themselves within the group. Alright, no problem. That's what I wanted to know. 24. Tyler Corp owns 100% of Vail Corp's capital stock. Tyler purchases merchandise inventory from Vail at 140% of Vail's cost. During year one, merchandise that cost Vail $40,000 was sold to Tyler. Tyler sold all this merchandise to unrelated customers during year one for $81,200. Preparing combined financial statements for year one, what amount should be eliminated from the cost of goods sold in the combined income statement for year one? What should be eliminated? Alright, let me see. Here, the purchased merchandise inventory Vail at 140% of Vail's cost. During merchandise cost of that cost Vail $40,000 was sold to Tyler. Okay? Sold to Tyler. Now, what we need to know is it's gonna be 140%. Let's say 40%. 40% of the inventory is fake profit. All this merchandise to unrelated customer during year one for $81,200. That's good. But now we need to resolve that. They sold it to you. We need to resolve that part. It cost you $40,000 times 1.4, $56,000. So you sold it for $56,000 to yourself, but it cost you $40,000. What amount should be eliminated from cost of goods sold in this combined income statement? What I'm saying is, they say you should eliminate the whole $56,000. Why? Why would I need to eliminate the whole $56,000 here? Because I was gonna say, okay, it cost you $40,000. This is real cost. What's not real cost is the $12,000 or the $16,000. That's what I don't get. So why the whole $56,000 needs to be eliminated? Because there is a real cost of $40,000. It costs $40,000. Why do we eliminate the whole thing? If the inventory really cost the group $40,000, why eliminate 56? because we eliminate the internal purchases amount first. Then the real cost gets added back through the seller's original cost. Understand the internal sale. Vale's cost 40,000. Vale sold to Tyler at 140% of cost. So transfer price 40,000 times 140 is 56,000. Yes. So 40,000 times 1 is 56. So on separate books, company Vale Tyler records 56,000, cost of goods sold 56,000. Tyler. Consolidated perspective. From consolidated viewpoint, did the group really sell inventory for 56,000 internally? No. The inventory simply moved inside the group. So the internal sale must disappear. The internal purchase must disappear. That means eliminate the full internal transfer amount of 56,000. But what about real $40,000 cost? This is the key. The consolidated group did truly incur $40,000 to obtain inventory. And since Tyler sold all inventory externally, the consolidated group should recognize true consolidated cost of goods sold. Here is the subtle accounting mechanics. On the books, currently, Tyler already recorded 56,000 as cost of goods sold, but consolidated accounting says no, the group's true cost was only 40,000, so the extra 16,000 markup must disappear. Why does the worksheet eliminate the full 56,000? Because the entry removes the entire internal transaction, typical elimination. Hey, we are through, my friend. And we have 17 minutes left. Done. Wow, this is amazing. Who's studying with me today? Anyone? Is there anyone who's studying with me today? No one. All right. No problem. No problem. 75%. Still have a few minutes left. We are done. Is there anyone studying with me today? Anyone studying with me today? No one? Nobody? Nobody. Anyone studying with me today? Alright, so if nobody's studying with me today, we are going to close right now. We have 15 minutes left. One of my mentors said to me once, formal education. One of my mentors said to me once, formal education will make you a living, but self-education will make you a fortune. So I deeply invested in my personal education. in my self-education. I invested a lot of that on that. But I realized something. I realized that sometimes formal education will be the key to open the door of fortune. So that's why I decided to get on the road of formal education after I have invested a lot in personal self-education. And to tell you the truth, this has helped me a lot. Self-education, personal education has helped me a lot. But I understand if we can balance that with formal education, if we have the credentials, if we have the papers, like people say, we can do great things. So that's why I decided to get on the road of personal education. My friend, today is a great day for you to work on yourself, because nobody's gonna do it for you. You gotta do it for yourself. Ain't nobody's gonna do it for you. All right? So if you feel that you are in a dark season in your life, I want to tell you that for a seed to become a tree, the seed needs to be planted. For a seed to become a tree, the seed needs to be planted. And when you plant the seed, no one can see the seed under the ground. You don't know what's going on with the seed under the ground until a few days, until a few months. You start to see something piercing the surface of the ground. It is the seed that has been transformed to become a tree. I don't know in which season you are in your life right now. Maybe you are currently planted. You are not buried. You are planted. And there is a moment that you will be coming on the surface. But for you to come on the surface, you need to do what you got to do. When you are planted, the seed is not buried under the ground. The seed is planted. There is a difference between being buried and being planted. When you are planted, even though you are under the ground, but there is a transformation that's being made in you. While no one sees you, while no one calls you, while no one knows what's going on with you, there is a transformation that's happening with you. And this is the beauty of being planted. The mistake that we make sometimes is when God plants us, we think we are buried. When God is putting us in a process of transformation, in our mind, we think that we have been forgotten. We think that we have been abandoned. But that's not the case. God has put you in a place, in an environment where you need to develop, my friend. And whatever you do in that moment, in that season of development, will affect your life when you come on the surface. The mistake we make is believing that when God plants us, is that we are buried. My friend, you are not buried. You are planted as a seed. And where you are right now, under the ground, in the dark place, in the dark season in your life, you need to be working. You need to be growing some roots. You need to be growing some roots to strengthen yourself, because the time will come. The time will come for you to come back on the surface, my friend. And the fruits that will come out of you will be so sweet that people will come from different countries to come get your fruits. People will come from different cities, from city to city, to get your fruits. People will buy plane tickets. People will take bus. People will drive. People will get on the boat to come get some of your fruits. Because in the dark season, you were wise enough to develop yourself to become a tree that's planted by the rivers that will give fruits in each season. My friend, that's my word for you today. Keep studying, keep building yourself up, because the time will come for you to be on the surface. God bless. Have a great day.
Come study with me. Come study with me. Come study with me. Come and study with me. Yeah, late nights, clean notes. I want the whole lot. Gold pen on the page. Big dream, small cage. Put some credential behind your name. Walk in that room and own the frame. This is your time, your season to grow. One step at a time, watch your future glow. Yes, you can do it, yes you can. Rise from the doubt and make your stand. From high school diploma to EA, CPA, DBA, I see the fire, I hear you say, come study with me. Come study with me. Come and study with me. Come and study with me. Come study with me. Put your name on top, put your name on top. This is your season.
This is your season.
Yeah. Library cards, fresh highlighters, head down focus, future fighters. One more chapter, one more try, one more test, one more why. From high school diploma to EA, CPA, DBA, that's the climb, that's the way. This is my goal, what is yours? Open that door, unlock more. Yes, you can do it, yes you can. No more fear, just make the plan. Put some credential behind your name. Move with purpose, play that game. Come study with me. Come study with me. Come and study with me. Come and study with me.